Juan Delgado Morera, the co-CEO of Hamilton Lane, joins us now. Juan, great to have you on the program. Let me just kick off with the latest story of the day, the U.S.-China come down yesterday. I'm curious what this means for private markets. We've been talking all about the action in public markets, but give us a sense of what it means for your world.
Sure. I think we have a trade truce, not a tariff deal, which I think is important, and we kind of walk back from the ledge. But what it means for private markets is that you've defined a range of outcomes. So we operate in a longer time frame, we have longer dated capital, and what's happening in the market is that nobody could tell what the bottom was or what the worst possible case. So I don't think the worst is over, but I think we've discovered what the worst can look like. And that gives you really a range for pricing and a range for more activity. No longer the case of wait on the sidelines, but now you know the framework.
And what is your expectation for activity in the coming months? I mean, clearly, given the volatility in public markets, one of the key exit routes for private equity has been closed, i.e. the IPO market. We've in turn seen a major uptick in secondaries. What is the pipeline looking like for you in terms of exits?
I think you hit it on the head in the sense that there's a range of activities, it's a range of sectors, and it differs, right? So the buyout piece, the equity financing piece, has been waiting a little bit on the sidelines. And there's been less activity than we would have forecasted because of the volatility and the macro, which I think is being addressed with the changes that we heard yesterday. So we expect more activity on the equity side. Credit has been very active, as you led into the piece, and we'll continue to do that. And secondaries has been exactly even just red hot. We can go back to that.
Red hot. Okay, that's interesting. The secondaries have been red hot. What are you seeing in terms of pricing, though, in secondaries?
Secondaries are red hot because it's really the best instrument that private markets has to participate in a high volatility environment, potential distressed sellers, high volume of selling versus buying interest. All of that is really going to play to buyers. It's a buyer's market. This is not a new market. This has been growing steadily, still relatively small. It's under 2-3% of the whole primaries market. And it's been the right tool, tried and tested in scale and size. And that's why you've been seeing them more active and capturing the pricing opportunity.
Well, in terms of the pricing of assets, you said it is a buyer's market, yep. and yet you also mentioned in the sentence before that it is a highly volatile market. I wonder how quick the pricing of assets in the private sector is to respond to that volatility, given the fact that it's not a stock market. We don't have to see immediate move by move. Right. So is the pricing and the realization from the sellers a slower process, a more difficult process for them to adapt to the new environment? Or actually, is it better that they hold off through these periods of volatility and wait for things to calm down?
A lot to unpack on the question, if I may. So I'd say the first part is the market prices off of a combination of the latest NAV that is known, plus all the information that you're supposed to have and the advantage that we at Hamilton Lane as private market practitioners do have. So it's not a public market, it's not a transparent market. But you are obviously reacting to the market daily. And in fact, you have a closing period of time where you can have cash flows and activity. And so it's a good market from the point of view of having a willing seller, a willing buyer, and striking a good price that is current. So that's on the technology piece of that. In terms of the cycle and the volatility, it's a market where the pricing can track the cycle. You can see deals now struck at 92 cents on the dollar. Deals can come back up to par. So we can show you the data that shows you the evolution of that. Should we hold? Should we sell? Part of the other question.
Well, I've never seen an NAV yet on either listed or unlisted that it was below the market valuation. The NAVs always seem to be like, for instance, in the REITs or in the property sector as well. Yeah, they're very, very slow to come down to the reality of the current market, aren't they?
Not as much. I mean, this entire private markets industry is closer to fair value than we get credit for, frankly. And Hamilton Lane has been, we think, pioneer and bringing more data, more transparency, and welcoming that question, that line of questioning, and that approach. But again, remember that the transaction itself has to strike a price. And we're dealing with a very sophisticated institutional level of sellers and buyers. So no one is in distress from a point of view of absolute fire sale situation, and therefore these are bargains that are struck at current prices. And there's plenty of data on this space.
Okay, good.
Can I go back to your long-term picture, this long-term frame that you either market with? Because the reality yesterday was this message from Scott Bessent, the Treasury Secretary, talking about the fact that neither country wants to decouple. Right. All we've seen in recent years is decoupling. Yeah. Call it whatever you want, but everybody's been going in different directions. The US this way, the Chinese this way. Do you think that there is any truth to that that nobody wants decoupling? Or do you see down the line just further moves to separate away from each other to be less reliant?
We in private markets, well, I can give you a personal view because I mentioned earlier that I'm based in Hong Kong. The reality is that trend of resilience and supply chain alternatives, if you call it decoupling, has been going on for a number of years and is very likely to continue. However, this is an unprecedented statement that we had not heard, and is very much welcome, I think, on both sides, and very much welcome by the overall investment community overall. So I think all of the above, both can be true. You'll have the framework for the market to see the range of outcomes, as well as investment that will look for resilience and alternative and supply chain diversification.
Would you say China has suffered in recent years from that decoupling, that it has actually been unvestable because of the hands-off approach from the Americans?
I might surprise your listeners saying clearly no. I just flew from Hong Kong right before the Geneva weekend negotiations. The mood was not that, oh my God, we're suffering. Not at all. And so just for what it's worth, anecdotal on that. I think that if you go back to private markets, part of your question is correct in the context that a lot of the allocation to Chinese-based or even widely Asia-based allocation managers within global private market portfolios has been going down. I think that's part of where you're coming from. And that has started a few years ago and is likely to continue, actually.
I can see you've been invested in disruptive technologies, and I just want to get to that quickly because that goes to the heart of what we've seen in this decoupling, that the Americans are so concerned about the Chinese accelerating on technology and that eventually they'll get past the American edge one day. What do you see now that's worth investing in the Chinese market on the back of all that DeepSeek and Alibaba news from earlier this year?
Interestingly enough, AI has been much more investable in private markets in the US than it has been accessible in China. And therefore, you have to think of China as much more of a domestic consumption play for private markets investing.
Juan, let me ask you about a story that's been brewing in the U.S., and it's a huge story around university endowments. Universities have been, locked up, as many sectors have been, with the Trump administration, and are now potentially in a situation where they have to look for research funding elsewhere, given the tension that's currently in play with the Trump administration. University endowments, big holders of private equity. Harvard is reportedly considering selling down some of its private equity holdings, and you've got Bill Ackman saying this could be a huge headache for private equity funds if we see other universities follow suit. Can you weigh in how worried PE should be about this?
Absolutely can. They've been long-term participants. They are known for the returns they've obtained, for their very high allocations to the asset class, to the illiquid asset class in the 50s or so. And from that point of view, it merits this conversation. However, you pull it back to the flows, to the size, they are not the largest allocators in dollar terms to the asset class globally. So it's a bit of a share of mind versus share of wallet. And so I'll take a red disagreement with Mr. Ackman on that point, that the industry is much bigger than the endowment market. To the context of the question on sales that Steve was mentioning earlier, this is not the first time they've sold. There's liquidity in private markets through the secondaries market that we talked about, and they've been portfolios, but it's not unprecedented in size, and they will manage it well because again, you choose the timing of the exit, and the market has typically high quality portfolios to look forward to.
We had a great guest yesterday where we were talking about the process of de-equitization as well, i.e. the fact is there's a lot less companies in the public pool than there have been. But they're a very important part of the whole ecosystem as well, and very often part of the exit route for the private sector as well. How does that relationship look to you at the moment between public and private sector? Does it look healthy, or actually is there something that policymakers, exchanges, the sellers of companies, they need to change in order to make the relationship better?
Well, I would say, on the one hand, it's never really been the dominant exit route. It dominates the debate, but again, back to Hamilton Lane data, which we're happy to provide, it doesn't even get to 20% of the actual exit avenue.
Private to private
It's private to private, it's private secondaries, and the largest part of that pie is strategics. You sell in private equity to other corporates. I know that doesn't get enough coverage because it's kind of not transparent as much, and the headlines are. But that is the biggest buyer of private markets' own growth.
So take that board on board that point. But going back to the public markets, what is the problem there?
No, going back to the relationship in and of itself. I don't mean to leave your other question unanswered.
No, you go.
You have these changes globally asking for more companies to go public. This is like they can pitch you all day long. We private market asset owners get these changes and line up, send us more companies. More companies need to go public. That friction, the methods to go public, all of that, the size, the minimum size has been coming down, right? And it's a stage in the evolution of companies that is being part of the landscape. It's not as much the case in Asia as it has been out here, meaning that you still have more public companies growing. So the relationship is evolving. I go back to your question. Different structures can be actually made public, and there will be connectivity between being public and private in different ways. So I think everyone is trying to facilitate that, but it's not a panacea to the current liquidity crisis, perhaps, which is probably where you're going next.
I think we're going to leave it there. I'm going to go next to break because I've gone over and I shouldn't have asked the last question.
But Juan, it's been great to have you, and you'll have to come back next time you're in town. Juan Delgado Morera, the co-CEO of Hamilton Lane.